Hey folks, Dan Frio here, the rate update. Today is October 8th, 2020. What happened with rates today? Did they go up? Did they go down? Stay tuned. I'll let you know in a minute. Okay, today's going to be a fast one. Yesterday was 20 minutes. I apologize. I'm going to try to make this 8 year in and out. We want to know what rates are doing. But my concern is I want to tell you why rates are doing what they're doing and what I expect here in the, let's just do short term, the next couple of days or weeks. That's what you're looking for. You could care less what rates are going to be a year from now. You're looking to do something now. Who cares what they're going to be a year, 2 years, 3 years down the road? Who cares? So let's get to it. Today, the news out in the market, there was a bond market or a bond auction. It went terribly. So that's not good news. Some other news in the market was initial jobless claims were up 840,000. That's a huge number. Continued claims are at 11 million right now. And we also have 11.4 million getting unemployment with basically a care package from the government. These are people that normally would not get employment or unemployment benefits. Because they're what they call gig workers. They might be like, let's say you play guitar at a bar at night, and that's your job, and you get paid cash and tips and whatever. Those people now can file for a specific unemployment. So those normally you can't get unemployment with that. Well, they now can under the CARE Act. There's 11.4 million people getting that benefit. Some more news that's more concerning is California didn't report in these numbers. So these numbers are probably going to be worse than we even anticipated. Why didn't California report? Fraud. They're trying to get curtail the fraud out in California. So, these numbers can be worse than we maybe even thought. Based on that, the assumption would be rates would have got a little bit better today. But we're coming into normal times. The volatility is coming out of the market and everything else. So let's get on to what's going on right now and why. So you see the headlines here is saying rates remain steady as market volatility dies down. So there's not a ton of volatility. The Fed's stepping in and they're doing a fantastic job in volatility trying to stabilize the systems. So this is what we monitor on a daily basis. This is what's happening with mortgage-backed securities. A brief description of what this is. Mortgage-backed securities is a bond that trades on Wall Street as an investment that is the biggest determinant of what is going on with mortgage rates. So you have this, and then you have what's called loan level price adjustments. It actually is risk-based adjustments to mortgage rates. So the lower your credit score, the higher the rate. If the building or your place of residency that you're looking to finance is a condo versus a single family home, little more risk. If it's a rental property versus your primary home, a little more risk. The higher the risk, the higher the rates. So what we're trying to do is catch a trend here and see what's going on. So brief description of all this chart here to make it in its simplest form is I follow this on a daily basis to see what's the trends doing right now. So we watch trends and then we watch other economic figures. What's going on with inflation? What's going on with unemployment? What's going on with the freight index? What's going on with the GDP? All these things factored in, and I come up with, here's what I'm expecting mortgage rates to do. So let's look at the technicals here, is we saw basically we're coming right back down in line. So let me explain this chart for you real quick for those charties out there. This is basically what's going on with the price of the bond throughout the last quarter. The price of the bond. As the price goes down, as we all know, prices go down bad, rates go up. Okay, red is bad, rates are going up. Green is good. What green means is the price of the bond is going up, driving down the yield. There's an inverse relationship. The higher the price, the lower the yield. The lower the yield, the price, the higher the yield. That's the best way I can explain it when it comes to how this factors in. So we love when it's green because that means rates are coming down. That's its simplest form. So now we have, I'm going to go through these numbers right here real quick. We have a ceiling, long-term ceiling right here, a short-term ceiling, a short-term floor. And down here, I don't know if you can see this, but there's a long-term floor. We're going to focus in is on a short-term right now. You're looking to refinance or buy now. So what's going on? So this is the parameters we're looking at. Then we start looking into more details. We get a little micro on it. We're looking at a 25 DMA, which is day moving average. What's the average in the last 25 days, 50 days, 100 days? Okay, so that's where we're at. So those numbers are right here. You got the purple, which is 100 days. You got the black, which is right there. It's the 50 day. And you got the brown, which is the 25 day. I've been saying, and if you watch my videos, I've been saying we should be stable right through here. And that's where everything, all these things condense other than the 100-day moving average. You have, you're right almost in the middle of the averages that we have here with the short-term ceiling and floor, but then this is basically where your 25-day and 50-day moving averages condense. So yesterday when I spoke, I'm like, we're probably going to have a little bit of ease in the market because we're probably going to be back down in here. If you look at my video back on Monday, we were right here and I said, well, depending on what we do the next day, if we start out the day lower, I'm going to lock. So I locked a lot of people on Tuesday, and that was good timing. That was pretty good timing, but we've come back down. So again, the higher this is, so up in this area, the higher this is means the lower the rate. So it's kind of confusing, and I'm going to show you here in a second when you hear headline news saying, we just hit an all-time low again. Well, how, if this is here, meaning the rate here or the bond price here is higher than it is here. Again, higher here means lower rates because this is the price of the bond. So how are rates here lower than here? I don't know where they get their data, and that's where the media is kind of skewed a little bit. So that being said, I'm going to show you some headlines right here. She's cringing. I think she might be knowing she's taken a little bit of a fib. Mortgage rates hit new low as homeowners move to refinance. And she's cringing. I don't know if I don't know. So we'll leave it at that. You decide. If this is higher than this, we could not have hit an all-time low. Okay, that being said, I just educated you on that. I don't really anticipate any moves here. There's really no economic news coming out tomorrow. Next week, I don't really see any major concerns there. So what happened in the overall markets? We saw the Dow up 122. Bond market was weak. Employment numbers came in bad. And once California reports, it's going to be even worse. So why we didn't see the stock market plummet and bond rates skyrocket is to stimuli or not to stimuli. And that's what everything is contingent on right now, what the federal government's going to do in regards to stimulus. Okay, so now let's get on to rates. This is a chart I show every day. Basically, the averages. We're going to go over averages here. The average 30-year conforming rate right now in the market is 2.9%. That is 1 basis point, meaning 0.01. So this would be 2.91 yesterday. It was 1 point lower than it was yesterday. 30-year jumbos is 4 basis points lower. So yesterday we were at 3.13. Now we're at 3.09. So again, 4 basis points lower than that. FHA was up 1 basis point, and VA was down 3 basis points. This is the national average. You call your lender, guarantee you're not going to get that. Okay, I'm just telling you. Overall, if you look at these numbers, we're about 1% lower overall on where we were last year. So if you bought or refinanced last year, might be a good time. Just check and see what a benefit it might be to refinance again. Especially, talk with us and say, Dan, I refinanced last year. I paid some closing costs. I want to refinance again. Really don't want to pay costs all over again. Let's see where we can get you at maybe no cost or minimum costs. Okay, so please ask those questions. So now what I want to get on to is, where are my rates today? So let's get to that right now. My rates haven't moved. Okay, so yesterday somebody said, Dan, I don't understand what this first part of it is or whatever, so I apologize. The first section we're going to go over is where my conventional / conforming rates are. It's the same thing. There is no conventional is this, conforming is this. It's basically one word meaning the same thing. Okay, so let's go through it real quick so I can review these with you and kind of go over exactly what this terminology is and what are we factoring in to come up with these rates. So basically the background of this is all these loans that I'm basing these rates off of, it's a $250,000 loan, okay? On this first page we're looking at is a 30-year fixed conforming rate. This section right here is going over if you're looking to buy a house, meaning purchase, or you're looking to do a rate and term. What rate and term means is you currently take your balance, and that's all we're refinancing, just the balance, to a different rate and or a different term. So you might get a shorter term, a longer term, a different rate, so forth. So I hope you understand that part. 30-year fixed. Cash out, what cash out means is you're pulling out cash over $2,000 more than you owe on your current balance. So for example, if you owe $200,000, if we do a loan for, and you're getting cash in hand, so you end up getting $5,000 at the closing, that's cash out. If you're getting, Dan, I want $50,000, cash out. Okay, so there is a difference with rates. So please let us know that, you don't want any cash or you do want cash, because it does factor in all of this. Next thing you know is this section here. So this is your credit score. We use your middle credit score. So we pull all three repositories. We pull Equifax, TransUnion, and Experian, and we use the middle score numerically. So if you have an 800, a 770, and a 750, we use 770. What's used also, if there is a co-borrower, we use the middle lowest score. Let me make sense of that. You have you and a spouse or a partner. Your scores are 800, 790, 780. So your middle score is 790. Your partner score is 760, 750, 740. So their middle score is 750. That's the score that we use. We use the lower middle score borrower. Hopefully that makes sense to you. This last number here is what we call loan to value. So meaning what this calculates, how you figure out this calculation is the loan amount divided by the value of the property. Okay, so for example, a $100,000 loan amount divided by a $200,000 property is a 50% loan to value. Okay, so that's the basics on this rate sheet. So now let's go through it. If you're looking to do a purchase or do a rate and term on a 30-year fixed rate, conventional, you have a 740 credit score. You can do I can't post all the rates, so we have rates up to 97%. We have rates at 50% loan to value. So I can't go through every possible scenario. So I just want to do this scenario. 740 credit score at 80% loan to value. Your rate's 2.875 with an APR at 2.952. So this is your rate. This is your APR. Best way to learn APR, just Google it. Google has a fantastic explanation of APR. Okay? So next tier is 700, and at a 700 credit score, your rate would be 3.125. At a 660 credit score, your rate would be 4.125. Basically, starting at 640, every 20 points on the credit is a different rate. So I can't fit them all on here. I'd be on here all afternoon. So you go 640, 660, 680, 700, 720, 740. You have all those buckets. But I just wanted to give you a range just to explain to you the rates are different based on the credit score. Now we're looking to pull out cash. Okay, if you have a 740 credit score, it's 75% loan to value. Rate's 2.99. 700, 3.375. 660, 4.625. Okay, as the credit scores go down, the rates go up. As you noticed what I said on the first page when we were going over the MBS market, I said the MBS, that number or the rate on that mortgage-backed security is the biggest piece or the biggest component of mortgage rates other than loan level price adjustments, meaning risk adjustments. So you can see a riskier loan is somebody who has a lower credit score. So because of that, your rate goes up. Okay, so now let's go on. We're going to look at what the 15-year conventional rates are. Okay? So it's basically the same parameters. 740, 700, and 660. 80 loan to value. Purchase rate and term. I just changed the term. Okay? 740 credit score at an 80% loan to value, 2.375. 700, 80% loan to value, 2.375. 660 at 80, 2.5. Then we go to cash out. Again, you're pulling out cash. You're refinancing your current balance plus pulling out cash to fix the house, pay off some bills, put some money in the bank, just put a cushion in the bank. Anything you want to do. 740 credit score at 75% loan to value, 2.75 is the rate. 700, 2.875. 660, 3.125. Okay, so that's the rates on the 15-year conventional terms. FHA rates today. Again, none of these really changed because the market didn't move enough. On an FHA, you can purchase a house with 3.5% down. So if you put 3.5% down, that means you mortgage 96.5% of the house's value. Most people, when they're doing an FHA loan, they're doing one of two things. They're either buying the house or refinancing with our FHA fast and easy streamlined process. So that's what they're normally doing. So I only posted purchase and refinance. Didn't do cash out, but there is a cash out feature. So let's go through with these. 740 credit score, your rate would be 2.75. 720, same rate, 2.75. 680, same rate, 2.75. 620, that's where you start getting a bump, 3.75. We start our rates on FHA, the FHA program, down at 600. So if you have a 600 credit score and you're looking to do something, I can help you with an FHA program. Now, lastly, on the government-backed loans, we have VA. VA can go to 100% financing, 100% if you're looking to buy or refinance and pull out cash to pay off bills. Those rates are fantastic. 740 credit score at 100% loan to value, 2.75. 720 score, 2.75. 680 credit score, 2.75. 620 credit score, 3.75. And again, these scores for VA, our VA programs, go also down to a 600 credit score. Now let's go to the jumbo. We're getting a ton of phone calls on this, and we are killing it in the market. So if you're in the jumbo market, especially California, some areas of Texas, California, this is where we dominate in California. We have programs exceeding $1 million. But there's a lot of factors involved. So if you're looking for a jumbo mortgage, probably the best way to do is call us. But this gives you the parameters of what we can or can't do. Credit scores start at a 720. They go up to, I think we're doing right now, $3 to $4 million loans at 75% loan to value. We actually have a boutique program out in specific areas of California where we'll do $1 million loan up to 95% loan to value. Call us to get those details. But on our jumbo loans, 780 credit score, and this is purchase rate and term. 780 credit score at 75% loan to value. The rate's 3%. 3%. 760, 3.25. 740, 3.375. 720, 3.375. So those are my rates for today. So what I always ask people to do, if you like what you see, get in touch with us. Get in touch with us. I'm going to show you here in a second how to do that. So, but what I do want to ask you one thing. I think we hit 10,000 subscribers today. If not, please continue to click down below and subscribe. But you like this. You're like, Dan, that rate's fantastic. What do I do next? What's next? Well, I need to do one of a couple things. If you're already in the mortgage process right now and you got a loan estimate, you'll know what I'm talking about if you're in the process. As a lender, if you applied for a loan, we have to give you a loan estimate. If you're just getting the ball rolling, we can send you what's called a fee worksheet. We can't send you a loan estimate because you never created a loan application. On there is basically your name, your address, the value of your home, the loan amount that you've approved for or you're quoted on, the rate, and the fees. The fees. Yeah, I should put that on a loop because most people, they get bamboozled. They're like, they'll hear from their mortgage advisor and they're like, oh, your out-of-pocket expenses are $50. But then when you break it down, I'm like, Mr. So-and-so, do you realize they're charging you 10 grand? What? They said my out-of-pocket expenses are $50. Yeah, that's all you got to pay out of pocket, but they're financing all that. I hope you guys care. Hope maybe you don't. But if you do, that's where I come into play. Send me that loan estimate or the fee sheet that you have. I'm going to give you my information here in a second. Just email it to me. I'll review it. I'll break it down with a red pen and tell you exactly what I can or can't do. Sometimes I go or email back and say, God bless you. What you got is fantastic. Don't know how you did it, but you did a great job. I can't beat that. Most of the time, I'm writing all over that thing saying, my rate's better. My fees are half the price. Let's get this done. Let's move forward. Click down below and get this thing started. So how do you do that? Well, the best way to do that is go to my website. My website is therateupdate.com. Therateupdate.com. Scroll down here. This will give you the 800 number, how to get a hold of us. I got right now nine loan advisors with several coming on board. You can call us 844-775-LOAN. It's 844-775-5626. Love for you to follow us on any of this social media. I post all this information on there as well. But what people do most of the time is they want to get me that loan estimate or that fee sheet. So my name is Dan Frio, DANFRIO. So I ask you to email me that quote to dfrio@preferredrate.com. That's the best way to do that. But if you're on here and you're like, Dan, I haven't started the ball rolling. I love what you're doing. You got great content and you're showing me rates on a daily basis that's beating everybody. I want to get rolling. Click apply now. It'll take you right through our system. It's really fast and simple. At the end, it's going to ask you to upload some documentation, such as a bank statement, a mortgage statement, a couple different things. Please upload those, because if you do, it makes the system even go more efficient, faster, and more detailed on our end. So that's the best way to get in touch with us to get the ball rolling if you're looking to refinance or buy a house. That is it for today. So I want to thank you guys for watching. That's it. If you need me, reach out. Otherwise, I'll see you tomorrow. Same time, same place, God willing. And be safe, be happy, enjoy the day. Bye-bye.